It's been hard to figure out what the real connection is between the trade war headlines and rhetoric and what's actually happening in the market, because risk assets have mostly held up pretty well. Where do you see the most dislocation and hence the most opportunity?
So we, earlier this week, created a pretty interesting tool for clients, calling it the Trade Risk Radar.
Yeah.
And in this, we are trying to capture various asset prices that we think are being affected by various components of the trade war. So some of the assets are in volatility space, some of the assets are in equities or in rates along the dimension of China, NAFTA, Europe, autos. One of the ones that we found to be pretty interesting is what we think about as global value chain, which includes the global semiconductor price index, ex-US versus the US. So almost everything has fanned out compared to where it was 2 months ago. The two things that interestingly stand out are HSCEI or FXI vol, which has not really moved
That's a China ETF.
That's a China ETF. And the Japanese yen, which typically would be considered a pretty close proxy for global risk. And that's sold off over the last 2 months or so, contrary to what one might have thought if this was becoming a broad globalized risk issue.
So are traders or are investors at this point getting compensated for taking that China exposure volatility risk?
That's a really great question. And the way we've been thinking about it is, because nobody really knows how this is going to play out, there is no real precedent or empirical analysis that you can rely on and say, hey, this is what this looks like. So instead, what we've been thinking about is, can we line up different outcomes or scenarios, not be too focused on getting it precisely right in probability terms, but try and figure out which assets might be somewhat mispriced relative to the risk that is associated with them. So take FXI again, which I referenced earlier. We think a put spread in FXI is somewhat mispriced for an escalation in the trade war. On the other side, EWZ, which is the Brazilian ETF, that might be underpricing, that has sold off so much, it's come back a little bit in the last few days. A call spread on that is pretty interesting from the other side. So instead of focusing on saying this is the best trade, we've been telling clients, try and have the sort of portfolio view and take exposures on both tails if things change. The other trade that we really like is the seagull in the VIX, which is where you sell a put to buy a call spread, which lines up very, very attractively because you're not bleeding away carry.
So explain that for those who seagull trade, selling a put, buy a spread. What exactly is the idea that you're expressing here with regards to volatility and the opportunity? So
when you are buying an option on volatility, it is pretty costly because there's a negative carry associated with owning that option. Because we believe, and we've built a macro volatility model in which policy uncertainty is an input, we think that there's a floor to volatility for the foreseeable future. And because of this floor, we are willing to sell a put to fund the calls that we want to buy on volatility. Typically, if you're doing something like just buying the calls, if nothing happens, you end up just losing the entire premium. Oh, so you remove that bleed away by selling that put because you're just not too nervous about a big plunge in volatility. Exactly, because we think that there's a floor that gives us confidence and helps us fund the other side of the trade. Let's talk about the yield curve. Tons of talk about that lately. Steepening today, but the dominant story is the ongoing flattening. What's it telling us and what's the opportunity there? We did some deep dives into the yield curve earlier this year, and our takeaway was that yes, the yield curve inverts before a recession happens. That just happened multiple times in the past. Though research, not only ours but elsewhere, suggests that this is not something that, for one, is universal. In the US, it works a little bit better than elsewhere, and its efficacy is not constant. It's changing over time. Our focus is, okay, this is fine, but how do we use it? What is the utility of it? And in the signal that is the most interesting one from our perspective was, if the yield curve starts to re-steepen, and especially bull steepen, which means that the front end rallies faster than the back end, that is a much more powerful signal for a negative outcome for risk assets. So instead of trying to be the smartest person in the room and figuring out what is the level that is bad, when does the inversion stop, when does the flattening stop, we would rather just wait to see the bull steepening show up and then turn negative, especially when it relates to the yield curve.
So we don't read too much into it now, but if we see a big rally, people buying hard on the short end, and we see that steepening, historically that would tell us caution on risk assets.
That's exactly right, and the rationale fits with why are people rallying the front end faster is because the bond market or the Fed is telling us that things are getting bad.